All right, markets are, I wouldn't say they are shell-shocked or something, but yeah, last week in a sense really broke the back of mid and small cap stocks. You could blame it on the general mood, risk aversion, or the fact that in a market like India, where growth is not there, valuations are high, if you impose more taxes for an investor who is a global investor who's got a choice to participate in equities and other markets which give you a better post-tax returns and better promise of growth and better evaluations, then India clearly will be on the receiving end. And that's what happened that I think trend is visible in the month of July so far for institutional investors. In the month of July, they've been net sellers to the tune of about 7,000 crore. GIRISH Pai joins us. Let's take the conversation forward. GIRISH, is this just a beginning of a prolonged decline and a prolonged reversal in flows, given that in India growth is not there, valuations are stretched, and the post-tax returns suddenly are not that promising after the budget?
If you're talking from a 6 to 12 month perspective, I would agree with you. I think earnings growth, in my opinion, is going to be marked downwards starting this quarter. We've already seen quite a few sectors which have disappointed the street. We believe that the sectors which typically give credit to the economy are kind of pulling back on that, becoming more risk averse. If you look at what the managements of DCB, on HDFC Bank, all these are kind of stating are basically that they're kind of trying to pull back on lending, does indicate that probably we could go into a situation where economic growth could be like 6.5% type. Earnings growth will probably come off from the 20-25% that market is currently anticipating for FY20, maybe towards the mid-teens kind of situation. So if you look at earnings for FY20, a lot of the delta is coming from corporate banks, whereas the expectation was that the other sectors are kind of hold on. My sense is that view is probably changing. The other sectors are not going to deliver as much growth as expected. And I think the corporate banks will also see some asset quality issues arising at the margin. So I think the whole NBFC crisis, the consumption slowdown, the fact that banks like HDFC Bank and the others are not going to lend very much could mean that there could be some asset quality issues that may pop up over the course of the rest of the fiscal year. So those are some of the things that one needs to watch out for. I think the bigger thing from an FI perspective is, while we've seen lower yields abroad and there is a case for shifting money away from negative yielding territories to a market like India, there is also this worry about a potential slowdown in growth, a very drastic slowdown in growth one might potentially see in the US. So I think that's probably what's weighing on the minds of investors globally.
Girish, wanted to get in a take as to what the outlook is on HDFC Bank. It's been business as usual, but there have been certain concerns that have been flagged off. For instance, there's been a mild deterioration in the asset quality. You've seen growth moderate a little bit, as well as the auto and the agri sector. With the management even acknowledging this, given that this has been a very steady performer, should one really read into the fact that when an HDFC Bank is talking about caution, that things could get a little worse?
Yeah, to some extent. I think if you take a long-term view on HDFC Bank, it's one of those steady compounders that one has in the market. One of those solid stocks which have delivered year-on-year growth, both from earnings perspective and book value perspective. I would think that should be one of the core holdings in your portfolio. But having said that, I think in the near term, I think there are issues. As I mentioned, there is collateral damage that's probably visible from the NBFC and the IL&FS crisis. The fact that certain parts of the economy are not getting the kind of credit that they used to get in the past is resulting in slower growth, probably some asset quality problems kind of developing out there. So I think it's logical that a bank like HDFC Bank, which is fairly cognizant of the risks in the economy, is probably holding back in terms of going out and lending on the auto side and some of the other parts of the market. So I think, yes, there could be a little bit of a problem from a growth standpoint in the immediate term, but if you take a slightly longer term standpoint, I think it's a core holding that one needs to have. We need to ride through some of the volatility we'll probably see in HDFC Bank in the near term.
Girish, 6% is where the bond yield is headed, or 6.2, 6.3 where the bond yield currently is. What do you think it means for banks? What do you think it means for borrowers? And when do you think this crack in bond yield will start revitalizing consumption and demand?
I think it's going to take a while. I think bond yields have come off from about 8.2% levels to almost like 6.3, 6.4% levels, and you said it can potentially go to 6% levels. So I think the deposit interest rate as well as the lending rates have not actually come off to that extent. To some extent, I would blame the government. One is that your small savings rate has not actually come off that much. It was brought down by just about 10 basis points, whereas my economist tells me that if it were to be benchmarked to the yields, it should have come off by almost as much as 80 basis points. So I think there is an issue there in the sense that government needs to borrow from the market to satisfy some of its its obligations. That is one aspect. I think this whole transmission is going to take a while. The liquidity has to improve. It's improved quite a bit in the recent times, but I think it will take a while. So I wouldn't lose hope. I think it's going to take a while. This whole slowdown is not going to change. The situation is not going to change overnight. Maybe it could run through the entire of FY20. And the key thing to watch out for is, would we see a situation where a domestic slowdown collides with a global slowdown? And because we've not seen a serious slowdown in the US for a while now. Could that happen? And could that be the big event that one needs to watch out for going into the second half of FY20 and early FY21? So that is a kind of a thing that one needs to watch out for. But specifically on your question about when the yields will going to come off, I think they will. It's just a question of giving it a little bit of time.
Sudhin Choksi joins us, Managing Director with Growth Finance, to walk us through how should one read into the new NHB circular. Mr. Choksi, good morning. Thank you for joining us. NHB is saying that no 10 by 90 or 5 by 95 schemes will be allowed. What does that mean? Is this going to further have an impact on low-cost housing stroke HFC demand?
I think it has to be viewed from the point of view of the prudence. I think NHB has earlier also drew the attention of the HFCs, saying that these are the schemes which primarily accommodate the developer, because they get a funding in advance, corresponding to the progress of the work, and indirectly they are using a lower cost of funds. And then what happens? The borrower agrees to taking a loan upfront in advance, which will be serviced by the developer. However, what happens, in case if the project doesn't get completed or there is a delay, and then there are many customer grievances because the loan is being serviced, loan has already been disbursed, and the unit is not completed. So I think there are many customer grievances were there in respect of such schemes. So I think NHB has now restricted. Though as a prudent measure, they had cautioned the HFCs about it.
Could you outline that through this scheme of 10 by 90 or 90 by 10 by 90 or 85 by 15, what was the total activity which was happening in the real estate market, and how large is this exposure for the small builders?
I think mainly it has been done by the large builders than the smaller builders. If you will see the various projects, especially during the period when the real estate sector has been slowing down, many new projects or many developers came out with a scheme that we will pay 10%, you pay only 10% margin, and the balance 90% will come by way of a loan on which the servicing of the interest will be done by the developers. So I think this has been done for quite a while now. It's nothing new which has happened, but it gets more spread over sector when the sector is going through a slower pace, and the funding issues are there for the developers.
Mr. Choksi, but could there be any discrepancy in whether or not some developers would be badly hit and some would be lesser hit? Because as we understand, even large developers will be impacted because they've heavily relied on these kind of subventions so far.
No, certainly. I think most of the developers, as you have rightly mentioned, lately, almost all leading developers, most of it, I think they have resorted to this practice, and there would be, in fact, it would be a slowdown because no more individual loans will be, disbursed unless until there is a progress of the work. So I think if you look at NHB's regulation, which has just come out, the circular, put three aspects of it. One, it should not be participating in such subvention schemes. Obviously, that funding to the developer will stop. Two, the disbursal of the loan should be linked to the progress or the construction progress. And the third, that all HFCs are expected to put in place a system to monitor the progress of the construction. So I think there is a lot of responsibility put, and therefore developers will face further difficulty.
Fair enough. So clearly some of the big developers are likely to be impacted by this scheme. Thank you so much, Mr. Choksi, for joining in and giving us those details. Well, let's move on. A whole host of stocks to keep on your radar this morning. But among the lot, there's 5 in particular that you should watch out for. First up, it's Reliance Industries, the Jio surprise. Retail as well has been a solid performer, and that has cushioned the overall petchem performance. So watch out for that stock. HDFC Bank, strong set of numbers overall, limited NPA stress as well for the bank in Q1. Meantime, it's Interglobe Aviation. It's been the highest ever quarterly profit. The management has tried to assuage the concerns between the promoters with respect to the spat. Cipla, there's been a routine US FDA inspection at their Bengaluru unit. I think some approvals as well just have kicked in for Cipla, so watch out for that stock. And finally, in terms of the mid-cap numbers, it's L&T Tech that has cut the FY20 revenue guidance, so watch out for that stock. But in the meantime, let's take it across to Ajay to delve into RIL's numbers. And Ajay, let's talk about the overall performance as well and where there were a few hiccups as well.
Well, Reliance Industries managed to surprise the street with relatively better numbers compared to the muted expectations the market actually had from Reliance this quarter. The refining did not really fell off the cliff as the street was actually expecting, but braved, the performance. Petchem actually expanded, whereas Petchem margins were expected to be under pressure because of adverse pricing scenario, but they improved the product mix. The only point which the analyst committees, were talking about cautiously is about debt reduction cycle of the management, which they have indicated so far. Surely a Brookfield deal has been done, but that's very small compared to the overall amount of debt which still is there on their books. The great part is that now consumer end of the businesses have started performing over 30%, 32% in fact. Jio and retail both grew very well despite some pressure on ARPUs. And the management, Mukesh Ambani, has clearly told about how going forward consumer will be leading the growth. But after several years of decline, almost zero contribution from oil and gas, they have guided for the KG-D6 gas to start coming back mid-2020 onwards. In fact, they've also announced their AGM on 12th of August, and now the focus says that they say that the focus is on reversing the flows from KG-D6. So good commentary, decent numbers, and the stock should tick in the green as per most of the analysts we have spoken to and brokerages which they report this morning.
Okay. CK, on the charts, how is Reliance looking?
Well, I think Reliance is, as of Friday, testing that very strong support that it has created over time at 1250. Now, we have closed somewhere near that level, so that is not very happy augury, but the good results should propel it upward from this support. That is what one looks forward to. However, one has to be cognizant of the fact that the whole market had a chance to look at it. The SGX is still not happy. It's trading down. HDFC Banks were result down. Indigo results were super. Despite all that, if the SGX is showing a little bit of negative, I think people are not in too much mood to take markets up. So would that affect Reliance prices? That's something for us to see. But then if it were to drop between the 1225, 1250 range, I'm giving a 25 rupee, buffer zone for it to crack below. If it does that, then I think we should give up on bullishness for the time being and expect a little lower. But if it were to survive, then 1300, 1350 is what is on the cards once the markets improve.
Okay, charts and fundamentals, speaking a different language today on Reliance Industries. Prabal Sen joins in with his take on Reliance's performance. Prabal, hi, morning. What is your own verdict on Reliance?
Well, the numbers actually came in ahead of what we were looking at. And I think the key takeaways for me are that... Hello?
Prabal.
Hello, am I audible?
Yes, you are. Go ahead, please.
Yeah. Sorry, I said that the results have come in ahead of our estimate, if you were to look at it. And the primary beat has been led by the fact that, despite the higher OPEX that we have been building in for the Jio business, because of the change in the capital structure, the impact on P&L actually has been much less than what we were looking at. Primarily because there have been some Ind AS adjustments related to lease accounting, and the fact that I think fiber business has still not been commercialized. So therefore, those charges are yet to flow through to the business. If you look at downstream earnings, I think given how challenging the macro was, the performance of both refining and petrochemicals actually has been fairly resilient. On a YOY basis, yes, it looks very, very weak. But if you look at quarter-to-quarter performance, I think the sequential performance actually has been slightly ahead of estimates. The real thing to look forward to in the next 9 to 12 months is that if the recovery happens in the refining business because of IMO, I think that is something that should actually reinvigorate the refining segment. And if you look at the performance of Jio and retail, that actually continues to be stronger than what the street has been looking at. So to our, in our opinion, I think it's the petrochemical business that is the only monitorable in terms of whether this quarter will end up being a bottom one in terms of product delta, or there is further weakness in store. I think that will probably drive cash flows and profitability growth for Reliance in the next year or so. Other than that, frankly, there's not much that I'm worried about as far as this business is concerned. So we remain positive with the caveat that the petrochemical business could throw up some nasty surprises over the next 9 to 12 months.
The fact that, Prabal, the debt for Reliance is still on a very large, proportion. Do you think that will start making markets worry?
I think, if you look at the net debt number rather than just the gross number, that net debt number actually was inclusive of suppliers' credit, was trending at, almost 2.5, 2.6 trillion. That number has actually gone down to less than 2 trillion now. So yes, the gross absolute debt number remains, high at about 2.8 trillion or so. But if you factor in the cash that they now have, which used to hover in the 70,000 crore range, because of the changes in structure, that number is now standing at about 1,30,000 crore. So you've got to keep looking at the net debt number really for Reliance, and I think that does show the improvement that they promised with the InvIT. And our sense is that capex intensity will continue to actually go down, even from the first quarter level. So if that happens, you will see some deleveraging benefit coming through. The other aspect here is if you look at what they have done with the Brookfield deal, the 12,000 crore that has flowed through to Reliance immediately because Brookfield has taken over as the sponsor rather than, this debt being repaid gradually as people invested in the trust.
All right, Prabal, thanks very much for giving us your roundup on Reliance Industries. Let's get a move on there and get those mid-cap calls going on Trade Corner. Find out then what our chartists have picked out, and Dr. Narayan, going to come to you first. The broader end of the market also bearing the brunt of the sell-off that we witnessed. So what are your strategies here?
Well, at the broader end, I would be wanting to mix it up a bit, short Biocon, long IGL. These are the ideas for the day as such. And for the mid-cap section, I would be wanting to take a look at Just Dial. No doubt the results are due today, but the way the stock has been performing in recent times are definitely not suggesting any nervousness about numbers coming up. But let's see what they are later. But as things stand on the charts, the trend is still quite bullish. And even if there were to be some sort of pullback post numbers, I think they would still present a buying opportunity. And for Just Dial, there is this huge mismatch between cash prices and future prices. So that particular point needs to be highlighted here. The price on the cash side is about 780, 785 levels. Compared to that, futures are trading at a deep discount at about 730, 35 levels. So take care of that while you are addressing the levels that we'll be flashing on the screen for you. These prices that I've referred to are cash levels, so the targets and stops are as per those levels.
The take coming in from Dr. Narayan. Meantime, let's get in some mid-cap trading strategies and from you, Kunal.
Same stock which, I think, CK sir also mentioned, it's IGL. the stock has been doing pretty well. The last 3-4 days we've seen steady price action. Volumes have marginally improved when the stock is making new highs on short-term basis. And I believe that on the back of this market volatility, if the stock tries to perform pretty well on the back of some slightly higher volumes, then it's probably a case of stock in a steady uptrend. So that's a buy. 332 is where I would place the targets and stop us at 318.
Okay, there you have it. And finally, then, Manas, run us through what exactly your strategy is from the broader end of the market.
Avan, I think after a very long time, we have seen weakness in gold finance companies because Manappuram and Muthoot witnessed a lot of selling pressure on Friday. And Manappuram, where stock has started making lower top to lower bottom, stock has broken its 100-day moving average. I think definitely here you can create short position. The target would be around 114. Take a short call here, stop loss should be around 128.
Okay, some fresh trading ideas coming in your way from the mid-cap arena, but let's tell you what's making headlines this morning from the Economic Times, and let's bring up the first headline for you first. This one's on Diwan Housing. Let's bring up that headline and tell you what exactly the Economic Times is reporting when it comes to Diwan Housing this morning. They're saying that this time around there may be a moratorium which could be slapped and that there are debt talks which are currently on and that a new plan may be in place by July 25th. And I would like to mention to our viewers that we would be reporting a big corporate news break on Diwan Housing itself coming up just very shortly, so stay tuned to this one. Next up, the other one in focus is also that pension funds may actually be tapping into diplomatic channels now. So global funds, it seems that they're looking at the diplomatic route, and big ticket investors are now looking at this particular route to tap into some funds. We'll be explaining that they are government entities, they can't become corporates, so there will be some nitty-gritties attached to this, but it seems that global funds are all ready to tap via the diplomatic route now. The big one, of course, this morning is the Shaktikanta Das interview in the Economic Times. The first from the RBI governor. He's talked about a whole host of things, saying that central bank is taking the necessary steps, talking about the global factors which are currently at play, and more importantly, highlighting and emphasizing that RBI is currently propagating lending of only clean money and be very watchful of the money which is being lent by NBFCs in the current state of affairs. Okay, but we promised that there's a big corporate exclusive coming up on Diwan Housing. Ajay joins in with all the details. Ajay, what is it that you're picking up on Diwan Housing?
Well, that's correct. Our sources say that Diwan Housing is on the cusp of signing the deal, the private equity deal, which has been spoken about for some time now. And we are gathering that this signing or official announcement could happen as early as this afternoon. Now, why this is very important is because this was the this was the particular company because of which the entire contagion or the NBFC crisis actually erupted from. So 90,000 crore debt right now among at least 10 banks. The key ones, of course, are SBI, Union Bank, Bank of Maharashtra, Yes Bank. All of them will be benefited. We understand that the transaction could be happening in this structure that almost 37 or 38% which the promoters hold. A big chunk of that would be taken up by the private equity giant Aeon Capital, which is a JV, and fresh capital infusion of $1.5 billion will actually happen into this entity. This is all. The other big development is that there will not be any big haircut taken by the lenders. The 5 lenders which I spoke about earlier have the largest exposure to DHFL, and the talk was, or the fear was, that a very sharp haircut of almost 40% would be taken. But our sources say that this haircut will actually not happen, and once the fresh capital infusion happens, which may happen in the way of rights issue into the company, the current promoters stake will fall by 75%, almost to 10% or even lower. And the new entity, the Aeon Capital, will run the show as the main promoter. We also are told that even the